Passive investment. Today it is one of the biggest buzzword among Indian investors. And there is no doubt that passive investment in India is growing big time. For instance, just 5 years ago in FY17, total mutual fund AUMs was 17.5 lakh crore rupees. Out of this, passive fund AUM was just 0.5 lakh crore. That's merely 3%. Fast forward to FY22, mutual fund total AUM became 38.4 lakh crore, and out of this, passive fund AUM is 5 lakh crore, representing 13% of total AUM. So basically in last 5 years, passive fund AUM has grown from 0.5 lakh crore to 5 lakh crore rupees, representing 10 times growth. And that's just the beginning of passive investments in India. AMFI, that is Association of Mutual Fund India, is projecting total mutual fund AUM at 69.3 lakh crore by FY25. Out of this, passive funds are expected to command an AUM of 25.4 lakh crore, representing 37% of total investment. So in the next 3 years, passive fund AUM is expected to grow 5 times. Hey everyone, my name is Sahil and this is my Personal Finance Academy. As passive mutual funds are gaining more popularity in India, there are many doubts regarding how exactly is passive mutual fund better than active mutual fund. Moreover, there are 2 ways to invest in passive fund. First is index fund and second option is ETF. Within index mutual fund, the most popular index fund is Nifty 50 index fund, and within ETF, the most popular ETF is Niftybees. So I have received multiple queries to discuss which is better between Nifty 50 index fund and Niftybees. So in this video, we'll first try to understand why passive mutual funds are gaining popularity in India, and then we'll look at most popular passive mutual funds in India, and finally we'll look at the key difference between Nifty 50 index fund and Niftybees and decide which option is better. Alright, let's get started. So there are 3 reasons why passive fund investments are getting popular in India. First reason is poor returns from active mutual funds. Many people have started investing in mutual funds in last 4-5 years. Some invested from their own research while some invested via a mutual fund agent. In both the cases, there is one common criteria to shortlist a mutual fund: past returns. Majority of investors give maximum preference to last 1 to 3 years of return and end up shortlisting mutual funds that generates maximum return. It is also convenient for mutual fund agents to push mutual funds that have generated highest return in the past. But after a few years, those investors have realized that the mutual fund where they have invested money is not performing well. Because there is no guarantee that if you select an active mutual fund based on past return, it will continue to outperform in the future. In fact, every year there is a different mutual fund that would outperform. Obviously, you can't keep switching the mutual fund. And even the research suggests that in the long term, majority of active mutual funds end up underperforming as compared to index return. And that is one biggest reason why investors are moving away from active mutual funds and investing in passive mutual fund. Then second reason is low cost of passive funds. In active mutual fund, the fund house charge a high fee, which is also known as expense ratio. For direct plan, it is almost in the range of 0.5 to 1.5%, whereas in passive mutual fund, this fee is between 0.05 to 0.5%. This is one big reason why active mutual funds struggle to beat the passive funds, because ultimately this fee would be deducted from your returns. So ideally you would want to pay a low fee, and passive funds provide that option. By the way, now I'm also sharing money management knowledge on Spotify. So if you are interested in listening to the podcast, you can explore my podcast Personal Finance 101 with Sahil Bhadviya. In fact, now you can even watch my video on Spotify podcast. Link is provided in the description. And if you want to learn every aspect of mutual funds, stock investment and money management, I have a complete course. Thousands of people have enrolled in my course to learn step-by-step process of investment. You can explore that course as well. Now let us try to understand which passive funds are getting popular in India. When it comes to passive mutual funds in India, the most popular index funds are Nifty 50 based index fund. Basically the funds that replicate the top 50 companies of India in exact proportion as per their weightage. Almost every major fund house today has a Nifty 50 based index fund. The simple reason is these top 50 companies of India are among the leaders in their sector and provides a good stability to the portfolio along with a decent growth potential. These names include the likes of Reliance, TCS, Infosys, ICICI Bank, SDFC Bank, Titan, Asian Paints, HUL, Nestle, Sun Pharma, Divis Lab, and so on. Basically, the bluest of blue chips. And the best part is this Nifty 50 index is also dynamic, where a poor performing company gets kicked out of the index and better performing company enters the index. Now there are two options to invest in Nifty 50 index fund. One is via mutual fund route and second option is via ETF route. So mutual fund, I'm sure you all understand. There is no need to explain. But ETF is relatively newer concept. It's called exchange traded fund. It is a type of index fund but traded like a stock where you can buy and sell ETF just like stock. Now within mutual fund, you have Nifty 50 based index funds from various fund houses including your UTI, AMC, Kotak, SDFC, SBI, Axis, ICICI Prudential, etc. Likewise, within ETF, there are multiple options from various fund houses including your SBI, Kotak, ICICI, Motilal Oswal, Nippon, and so on. However, the most popular Nifty 50 based ETF is from Nippon AMC, which is also popularly known as Niftybees. Like I said, Niftybees is not the only Nifty 50 based ETF in India. There are multiple ETF, but the most popular is Niftybees. And popularity play a very important role in ETF. And that is the reason we are comparing Niftybees from ETF category with entire Nifty 50 index fund category. Why Niftybees is popular, we'll come to that later. Now let us first understand the difference between investing in Nifty 50 index via mutual fund and ETF route. To begin with, please be very clear that Nifty 50 index fund is a category of passive fund where you can invest via multiple options from different AMCs. So you can pick UTI Nifty 50 index fund, SBI Nifty 50 index fund, SDFC Nifty 50 index fund, and so on. However, Niftybees is one of the ETF offered by Nippon AMC. Likewise, there are many ETFs in Nifty 50 ETF category. So on one side, Nifty 50 index fund represents an entire index fund category. Niftybees is one of the ETF from Nippon AMC. Essentially, both Nifty 50 index fund and Niftybees replicate top 50 companies in exactly same proportion as per the weightage of the company in the index on the basis of free float market cap. So in terms of risk versus return, both have similar risk versus return structure. If Nifty 50 index would jump, both Nifty 50 index fund and Niftybees would jump. And if the Nifty 50 index would fall, both Nifty 50 index fund and Niftybees would fall. The biggest difference between Nifty 50 index fund and Niftybees is the way they operate. Nifty 50 index funds are traded like mutual funds, whereas Niftybees is traded like stock. It means you can buy and sell Niftybees multiple times in a day just like a stock, whereas you can't buy and sell mutual funds multiple times a day. Now, if you remember, I said that Niftybees is the most popular ETF and popularity plays an important role in ETF category. It is because when you want to buy a ETF, you need to have enough sellers. Likewise, when you want to sell the ETF, it should have enough buyers. And Niftybees is highly traded ETF, which means there are enough buyers and sellers of Niftybees as at any point in time. So it is easy to trade Niftybees due to good liquidity. And liquidity is the most important parameter before you invest in an ETF. I hope it makes sense. The next difference is that you don't need a demat account and trading account for investing in an index fund. However, you need a demat and trading account to invest in Niftybees. As far as cost structure is concerned, both have an expense ratio. But if you observe, Nifty 50 based index funds have an expense ratio in the range of 0.06% to 0.3%. For example, Navi Nifty 50 index fund expense ratio is 0.06%, Kotak Nifty 50 index fund expense ratio is 0.18%, SDFC Nifty 50 index fund expense ratio is 0.2%, and likewise. Whereas Niftybees expense ratio is just 0.05%. So Niftybees has the lowest expense ratio. However, please note that since Niftybees is traded like a stock, there are other charges including your brokerage charge that would depend upon broker to broker. Then you have 0.1% STT on buy and sell. Then there is a small 0.00345% charge by BSE and NSE platform. Then stamp charges of 0.015% on sell, and there are DP charges. Then there is something called impact cost, which is the difference between buy and sell price. This impact cost would directly depend upon liquidity of ETF. Since Niftybees has a high liquidity, the impact cost is very low. So you need to consider all these charges with Niftybees. Net both Nifty 50 index fund and Niftybees have similar cost structure. As far as returns are concerned, since both Nifty 50 index fund and Niftybees replicate the same Nifty 50 index, the returns would be similar. There would be slight difference due to tracking error. Oh, by the way, you can set up SIP in index fund but can't set up SIP in ETF. Then one major difference between Nifty 50 index fund and Niftybees is price to NAV deviation. When you invest in Nifty 50 index fund, you buy the latest NAV, that is net asset value. However, in ETF, you don't buy the NAV. You buy the price just like a stock. This is an important difference that you should know clearly. When you buy or sell ETF, you do it on market price. That may differ from the underlying NAV of the ETF due to changing demand versus supply for ETF. Ideally, the difference between ETF price and NAV should be very low, but sometimes it can be high. And that creates volatility in ETF returns. Although if an ETF is popular like Niftybees, this difference between market price and NAV would be minimum. Now, if you are a long-term investor and willing to invest in passive funds, then it really doesn't matter whether you choose Nifty 50 index fund or Niftybees, as both essentially replicate Nifty 50 index and have similar cost structure. And since both replicate the same Nifty 50 index, the returns would also be similar. By the way, they would even have same tax structure on capital gain. However, if you are interested in trading, then Niftybees is the only option as you can't trade index fund. I hope this explanation helped you clearly understand the difference between Nifty 50 index fund and Niftybees. And if you want me to cover any specific financial topic, let me know in the comments. I'll see you next video. Till then, take care.